Hello everyone, welcome back to Trading Club 7U. I see many of you are eager to learn more about trading strategies, but you often get confused by terms like risk to reward ratio and expectancy. Today, we're going to break it down from first principles, and by the end of this lesson, you'll understand exactly what it means and how it applies to your trading. The number one mistake most beginners make when starting to trade is they don't think about the risk. They get caught up in the excitement of making money, but they forget that trading always involves some level of risk. Let me give you an example. If you're trading with a 1000 account, and you place a trade that could potentially lose 200, you're taking a 20 risk. That's huge. If you're not careful, you could end up losing a significant portion of your trading capital. Now, let's talk about the risk to reward ratio. This is a measure of how much potential reward you expect relative to the risk you take on. A higher risk to reward ratio means more potential reward for the same level of risk. Let's use a simple example. If you buy a stock and you expect it to go up by 1 for every 2 you invest, that's a risk to reward ratio of 12 or 50 reward. This means for every 2 you risk, you expect to make 1. On the other hand, if you buy a stock and you expect it to go up by only 0.25 for every 1 you invest, that's a risk to reward ratio of 14 or 25 reward. This means for every 1 you risk, you expect to make 0.25. Now, let's talk about why we want to aim for high risk to reward ratios in trading. We want to make as much money as possible while minimizing our risk, so we aim for high risk to reward ratios. However, as I mentioned earlier, the higher the ratio, the higher the risk of failure as well. So, we need to balance the two. A ratio of around 13 is a good starting point for most traders. This means for every 1 you risk, you can make 3. But remember, this is just a general guideline, and you need to adjust the ratio based on your trading style and market conditions. One common mistake beginners make is chasing high-risk trades with promises of high rewards. They see someone making big profits, and they think, I want to make that too. But they forget that trading is a marathon, not a sprint. We need to be patient and consistent, focusing on steady, profitable trades rather than trying to strike it rich overnight. Now, let's talk about expectancy. Expectancy is a measure of how much money we can expect to make on average per trade, taking into account both the profit and the loss. A positive expectancy means we're making more money than we're losing, while a negative expectancy means we're losing more than we're making. In trading, we aim for a positive expectancy, but we need to do it in a way that minimizes our risk. For example, let's say you have a trading account with a 1000 balance, and you make 10 trades. 5 of those trades result in profits of 50 each, while the other 5 result in losses of 25 each. Your total profit would be 250, and your total loss would be 125. In this case, your expectancy would be 250, 125, 125, which means you're making more money than you're losing on average. Now, let's talk about practical examples. Imagine you're trading a stock with a risk to reward ratio of 12. You place a trade with a stop loss at 50, and the stock moves up to 60. You make a profit of 10, which is a 12 risk to reward ratio. However, if the stock moves up to 65, your profit would increase to 15, which gives you a better risk to reward ratio of 13.3. Now, let's get practical. I want you to practice calculating the risk to reward ratio on a demo chart or in a paper trading journal. Take a stock or currency pair that interests you and estimate how much it can go up or down. Then, based on your analysis, calculate the risk to reward ratio. Finally, compare it with your target profit and adjust your strategy accordingly. To make it easier, let's use the following steps. For example, let's say you're trading a stock called ABC. You estimate that it can go up